Hi everyone, this is Theme 3 Calculations. I think this is probably one that a lot of students would say is the most tricky, just because I guess it's got the most complex calculations in it. There's two particular units we're going to have a look at here. So let's go through them all. We've got moving averages, 3 period and 4 period. We've got investment appraisal, decision trees and critical path analysis. Bit of a gauntlet in 3.3 actually. And then in 3.5 we've got ratio analysis and human resource calculations. So let's get started with these. So let's get started. On a normal kind of paper 1, paper 2, you would see these calculations as 4 markers. For obviously theme 3, that's going to be a paper 2. On a paper 3, you could see them as part of an essay question. So we've got loads of examples of this. We'll see some of those as we go through, where you would use the calculations and what you find to form part of an essay. I'm not going to talk through too much of that because I've talked about it in other videos as well. So where do you find practice exam questions that have calculations in them? If you go in the description, there's an exam question grid. And I've just shown the example of investment appraisal there. That has all the investment appraisal questions. As you can see, 2 of them are essays. And the 12 marker and a 20 marker from paper 3. The other 2 are 4 markers. So definitely worth giving all of those a try to make sure you know investment appraisal. It's obviously a tricky topic. You can do that obviously for all of the different topics as well. So let's start with the 3 period moving average. I'm going to go right into an example here. Here we've got a period of months and we've got sales, and what we want to do is we want to figure out a 3 period total and then a 3 period moving average. So what we're going to do is we are going to go through each of the 3 months and take January, February and March for this first instance. We're going to put that into the 3 period total. Then we're going to divide it by 3 to get the 3 period moving average. So January, February and March total is 380. The moving average is 126.67. For March, that would be February, March and April. So 405 divided by 3 is 135. April is 455, 151.67. May is 515, 171.67. And then June, which is the last one we can do. We can't do July because we don't have August data, is 520 and 173.33. So this is great if sales fluctuate and go up and down. This is really useful to use because you can see a general trend line. So you can see whether, despite the fact that it might be quite hard to see from the raw data, you can see whether the trend is generally increasing or decreasing. So again, with all of these, you can pause them as you go through, so you can give these a try. Here's an example of a question. This is a 4 marker. It says, calculate the 3 period moving averages for the percentage of rooms occupied in the periods March to May and June to August to 2 decimal places, and state the difference between these 2 moving averages. So we don't need everything here. We just need our totals, obviously, and our moving average. I'm just going to add these to the table, which is something you can do. As long as you get your answers right and put them in the answer box, you can answer your cases like this. I'm going to do this for a lot of the different sections here. We need March to May. So that is a total of 145 and therefore a moving average of 48.33. And we need June to August, which is obviously going to be 250 and then 83.33. So the last part of the question is state the difference. So we need to know the difference between the two. The difference is 35% rooms occupied. So for that one, it just asks you to do 2 of them and then calculate the difference between them. The 4 period moving average is more complicated in terms of process, and it is, a bit more complicated, but a bit more specific. So for this one, I've spread the table out in the same way that it's appeared in an exam question before. I'm going to just disappear a second. It's not a perfect example. There's not much in there. I'm going to show you a more in-depth one in a second. But we've got January, February, March, and April. It's the same data from the previous table, just obviously less of it because we can't fit it all in. What we're going to do here is we're going to calculate a 4 period total. So this is going to be January, February, March, and April. And that's going to go in the middle, which is why I've got that gap in between February and March, which allows us to put it directly in the middle there of the 4 months. So 120, 130, 130, 145. Obviously, if you want to give this a try first, you can pause it. That's going to get us 525. We're then going to do the same for February, March, April, and May. That's going to get us 585. Then to work out an 8 period total, we basically just add 2 consecutive 4 period totals together. So we're going to add, let me do the rest of the 4 period totals first. 645 is the only one we can do. Obviously, we can't do the one between May and June because we don't have August. So we're going to do our 8 period totals by adding the 2 together. So 525 plus 585 and then 585 plus 645. That gets us 1,110 and 1,230. And then to get, if we've got our 8 period total, to get our 4 period moving average, we just divide by 8. So the first one is going to be 138.75. The second is going to be 153.75. And then to calculate the variance in this, we just compare our sales to our moving average. So just do sales minus moving average. So this first one is going to be minus 8.75. And then the second one actually, by coincidence, is also going to be minus 8.75. So this is how this has looked in a past exam paper. This was quite a complicated one in a paper 3 essay. It was in a 20 marker. And it was basically about calculating a few different parts. You can see there's some gaps there, A, B, C, and D, and then using that to try and get an idea of whether, what the data was saying about their sales. So in this situation, you can see just from the sales that quarter 1 and quarter 4 are a bit lower. So it's obviously a seasonal business that has higher sales in the summer. So quarter 2 and quarter 3, and the moving average is going to show us whether the trend is increasing or decreasing because of the fact that obviously sales go up and down over the course of a year in this business, so it's quite difficult to tell. So we need to work out A, B, C, and D. So if we look at A, we've got our 8-period total at 590, and we know to convert our 8-period total into a 4-period moving average, we just divide it by 8. So that is going to be 590 divided by 8 is 73.75. Then to work out the variance, we do our actual sales, which in this case for quarter 4 2016 is 60, and we minus our new figure, which is A. So we're going to do 60 minus 73.75 is minus 13.75. And then we do the same process for C. So 610 divided by 8 it gives us 76.25. And then, what is it again? It was 60 again. Minus 76.25 is going to be minus 16.25. So what you can do with that is you can judge whether our moving average is, above or below our actual sales. Now in this situation, what we can see here is our moving average is actually trending up. So we can see that despite the fact that obviously sales drop in quarters 4 and quarters 1, generally speaking, as a whole business, over the course of like that time period, their sales actually are trending in the right direction. You can see that if you just look at the data anyway. So like quarter 1, if you compare all the quarter 1s, you've got 40, then 50, then 60, then 70. The quarter 4s have the same pattern. So it goes 50 to 60, and then obviously we don't see the quarter 4 for 2017 is 70. So you can see that it's trending upwards, and that is reflected in the 4-quarter moving average. But the variance also shows us that still in quarter 4 and quarter 1 we are still quite significantly below the moving average. So this business does have a drop in sales in the winter, and obviously the question was about whether they should offer winter activities. And one of the suggestions, I guess, is that might not be a bad idea, because you potentially then as a business could fill in some of the gap. However, maybe it's not necessary because their sales are increasing. In fact, actually, if you look at it, 2017 quarter 4 sales are at 70. Well, their peak sales in 2015 were 70 and 80. So their off-peak stuff is still growing at quite a high rate. Just in 2 years, their off-peak sales are as high as their peak sales were 2 years ago. So maybe they could just keep doing what they're doing. The next topic is investment appraisal. We've got 3 calculations here. I'm going to do them separately. So we're going to start with payback period. So investment appraisal overall is about looking at an investment project for a business and trying to assess, based on 3 different measures, whether this investment project is something that they should go forward with. And this first one is payback period. So our first positive cumulative cash flow denotes that we've reached payback. And then to work out the gap, we do the amount remaining to pay back in the final negative cumulative cash flow, divided by the following year's cash flow, and then times it by 12. That might not make sense without the example. So let's look at the example. The meaning here is how long it takes to recover the initial investment cost. So if we've got an example here where we are saying that the cash outflows in year 0, so year 0 being now, is 500. So this is a £500,000 project, and then we've got cash inflows and outflows during that year. We want to work out at what point do we reach payback. So we're going to first of all have to calculate our cash flow. Year 0, the discount factors, by the way, they're on there because we're going to use this later on for the net present value. We don't need that for this bit. So cash flow is negative 500 in year 0. That's obviously our money that we're spending now. Year 1, we have positive 130. Year 2, 160. Year 3, 185. And year 4, 195. So our cumulative cash flow, if we do like a running total of this, is going to be negative 500. And then add the cash flow, so negative 370, then add the 160 to get negative 210, then add the 185, so negative 25, and obviously in between year 3 and year 4, we do reach payback. I'm just going to get out of the way here. In fact, I'll get out of the way. So we can do a little bit more annotation on the side here. We can see that we reach payback there, like in between years 3 and 4. So we know it's 3 years and something, and we need to work out the months. So at the end of year 3, our cumulative cash flow shows that we still need to earn 25 grand, right? So we still need to earn £25,000, and in the following year we earn £195,000. So we want to figure out how many months into it are we going to earn the £25,000. Now, there's a weak point of this is that it's assuming that we're going to make the exact same amount of revenue every single month or every single day, I guess, which isn't true, but it still gives us a bit of an idea. So we're going to do 25 over 195 times it by 12 in months, gives us 1.54. So our answer is going to be 3 years, 1.54 months. So here's an example of this. We've got 2 examples, in fact, actually. We've got Buy It Direct. The chief executives calculated that the new bathroom project will not meet its target of 3 years. Using the data in Extract F, calculate the difference in the payback period compared to his target. So I'm just going to annotate the table here. One thing to be paying attention to is they don't have year 0, so we haven't got a cost here. Now, I want for my cumulative cash flow, I want my cost on there. So I'm going to add the negative 700. And then let's go through the rest. So we've got negative 500, negative 300, negative 100, and then in the end we have, at the end of year 4, a positive cumulative cash flow of 100. So we clearly see that it's going to be between 3 years and 4 years. So we know it's 3 years and a certain amount of months. We have 100 still to make. We make 200 in the following year. So 100 over 200 times by 12 is 6, halfway through the year. So that is going to be 3 years and 6 months. Now, the question said, what's the difference between payback period and the target? Well, the difference is 6 months because his target was 3 years. That's in the question. So make sure you get that little bit in there as well. For the second one, for Mondelez, I'm going to do the same thing here. I'm going to do this on the table. So our cumulative cash flow is going to be negative 75, negative 55, negative 30, 0, 22, and 42. The fact that it's 0 means it pays back at exactly 3 years. So the answer is just 3 years. Now, this was part of an essay question, and it also asked you to calculate net present value. Now, I'm not going to do that here because this is just a payback period example. I'm going to show you some net present value calculations later on. But of course, if you want to stop and do it, you can do it just for the practice. Average rate of returns next. So I'm going to use the same table. So I've just copied that over, and our calculation is the net return divided by the number of years, so the average annual profit divided by the initial investment cost times by 100. And the meaning for this one is it's the average yearly profit earned as a percentage of the initial investment cost. You might be familiar with the kind of concept of like return on investment. So like an individual investor, they invest in a business or invest in something, and they have like an average return per year as a percentage of their investment. This is kind of that for a business, but for a particular project. So it is how much yearly profit they make on average as a percentage of the initial investment cost. And for this one, the formula is net return. Our net return is our cumulative cash flow at the end. So our net return in this instance is 170. So 170 divided by 4, divided by the 500 initial investment cost, times by 100 gives us 8.5%. For this example, I remember when this one came up, and I remember students coming to see me after the exam being like, so I had no idea what to do with this one. And to be honest, I think if you asked me of all the questions that have come up on this course so far, which one annoyed me the most and I thought was the most unfair, I would say this one, because we taught this about investment projects, and then this is the only time this has come up, so that's why I'm using this example, and also because it's a really difficult one, so I want to use it as just an example so you know what to do in a situation like this. They said, for people in developing countries, purchasing a pair of Vision Spring glasses may be considered an investment. I just thought, we've got so many examples of business investment projects, and they go with buying a pair of glasses for £4 as an investment. So it was quite complicated, definitely for a 4 marker, but this is what it was, and this is how you do it. So we've got the price was £4, and then they estimate that the increased earnings because of having the glasses would be £108 in this developing economy, and they last about 2 years. So The net return, we know the formula, divided by the number of years in the initial cost. We're going to do this as a table just to make sure we don't miss anything. So we've got year 0, 1, 2, because there's only 2-year life of the glasses. The initial cash flow was 4, and then the next 2 years we generated an increased income of 108. So our cumulative cash flow is going to start with -4, then it's going to be 104, and then it's going to be 212. Really important that if you just added 100, if you just did 108 times 2, you might forget to take off the cost as well, because it's profit, right? So we have to take off the cost. So 212 over 2 divided by 4 times by 100 is 2,650%. A bit of a nonsense question, but don't write the exams, do I? So that's how you do it anyway. Hopefully, if you get it again, it'll be a bit more straightforward. And then the last one is net present value. I think concept-wise, this is probably the trickiest, but calculation-wise, it's not too bad. In some respects, it's the easiest one, actually. The calculation is the cash flow times by the discount factor, and then you just total them all up. So I've swapped out our cumulative cash flow column for a net present value column. The meaning here is it is the present value of future cash flows. And the suggestion here is that we are saying that in year 4, we are going to earn a cash flow of £195,000. And I guess the argument is that that is not the same as having £195,000 now. If we had £195,000 now, we'd be able to spend it now. And we can't, because we're not going to get it for 4 years. So there's an opportunity cost there that we just don't have access to that money. So we just say it's not as valuable. It's not the same value as having £195,000 now. So what we're going to do is we're just going to discount any future cash flows at a rate. And in this situation, we're using a 10% discount rate. And the discount factors would always be given to you. You don't need to memorize those. But in the examples we're going to look at, they're all the same. So all you do is do cash flow times by net present by discount factor to get your net present value. So negative 500 times by 1 is negative 500. 130 times 0.909 is 118.17. The year 2 is 132.16, 138.935, and 133.185. Now, to get our final answer, all we need to do is total these all up, including the negative 500, and that gets us 22.45, and in full numbers, because this is in thousands, that would be £22,450. Now, if that is positive, it's probably worth doing, but it is worth bearing in mind that obviously if a project makes all of its money in the long term, so like makes all of its money in the 4th year or the final year, then they're going to be more negatively impacted by net present value because most of their profits coming at a time where the money's discounted because it's so far into the future. Our net return was 170,000, so it's quite a significant drop, which obviously does suggest that a lot of the cash flow is made towards the end. For an example, wrong side there. For an example, we've got expansion plans at Northfield Cycles. This was a 20-mark essay, and it asked you to do payback and net present value. And it says, evaluate plan A and B, and which one's better. It actually tells us in the case study the net present value for plan A, so let's just write that down. Net present value is 4,989, so I guess we're looking to see if B is bigger or smaller than that. So let's write it down on our little table. We've got negative 60, 10.908, 12.39, 15.02, 17.758, and 17.388. That's by multiplying our discount factors. It's kind of annoying that they're not in line. They could have done that at least to make it a little bit easier for you, but nonetheless, that means our net present value for plan B is 13,464. So therefore it's higher. So that could be one of your arguments for the plan B option. The negatives, of course, are that it's much, much more expensive. And then there's probably others as well. I haven't read the case study in full for a while, so I'm not going to talk too much about that. But as a 20 marker, and it's definitely worth doing. It's also probably worth doing the payback period because that would also give you a bit of information you can use to make a judgment. But these essays are always worth practicing, especially before paper 3. Decision trees. So decision trees are, we've got two calculations here. The expected value, which is if we did the decision in a simulation, did it 100 times, on average, it's our average expected value. And then our net gain is how much we would get overall, so our expected value return minus the cost of doing it. And this whole thing is a diagram showing the potential outcomes of different decisions based on probability. So a decision tree looks a bit like this. So we've got the square represents a decision, so launching the current market or launching a new market. The current market costs 6 million, the new market costs 8 million, And then we've got a chance of success. The red circle, or just circle in the exam, is the chance. So we've got a chance of success 80%. We've got a chance of failure at 20%. If it's a success, it'll make 13 million. If it's a failure, it'll make 4 million. And then with the new market, success is 60%. Less likely to be successful. New market, I guess there's more variables there. But if it is a success, it's going to make us £18 million. And if it's a failure, it's going to make us 8 million. So we basically, for our expected value, we multiply our outcome by our probability to get a weighted average. So that is, in this situation, 13 times 0.8 and 4 times 0.2. So that's 10.4 and 0.8. Add those together, gives us 11.2 million, which is our expected value. So if we did that launch in the current market 100 times, we would get 11.2 million on average. Now, it's not how decisions work. You make a decision once and you have to live with the consequences. And it's all a prediction, but it's still helpful to look at risk because obviously, you know, our investment appraisal calculations don't consider the risk of something going wrong. They just consider one set of kind of like potential outcomes. For the other one, we're going to have 18 times 0.6 and 8 times 0.4. So 10.8 and 3.2 gives us an expected value of 14 million. For our net gain, we are, I'm just going to disappear, looking at 5.2 million for the launch in the current market. For the new market, we are saying that it's going to be 6 million. So in terms of net gain, according to the data, you're better off doing the new market. Now, there's plenty of reasons why you might not, plenty of reasons why you would. There's more to it than just doing these calculations, but that's what that calculation would tell you. So here's an example. This one gives you the net gain for the smartwatch. So they do a little bit of the work for you. So you just need to do it for the marketing campaign. So the marketing campaign is going to be 3 million times 0.6 and then negative 50,000 times 0.4, which gives us 1.8 million minus 20,000, so 1.78 million. You'll notice I've written the whole thing out there. The reason I've done that is because one's in 3 million and the other one's in 50,000. And so if you just write 3 in the calculator, 3 times 0.6, if you forget to kind of convert it over, that's going to be a bit of an issue. So I've made a point of writing it all out here. Our net gain is going to be, I'm in the way actually, hold on, let me get out of the way. 1,780,000 minus 360,000, which was the initial cost, which gives us a net gain of 1.42 million. So slightly higher than the smartwatch. Right, we've got critical path analysis as well. This is the last one in 3.3, so the big complicated models, I guess. We've got a diagram here of a critical path. This one's probably a bit more complicated than one you'd see in an exam, but nonetheless, I've kind of tried to draw a complicated one. Our calculation for ESTs are earliest start times, which is the earliest the next activity can start. We're going to go left to right, we're going to add, and when there are multiple paths to the node, we're going to use the biggest answer. For our LFTs, which is our latest finish times, the bottom node, bottom corner of the node, I should say, we're going to do the opposite. We're going to do right to left instead of left to right. We're going to subtract instead of add, and when we've got more than one path to a node, we're going to use the smallest answer. We've also got our float time, which is our latest finish time minus our duration minus our earliest start time for an activity, and that is how much slack time there is for an activity to be delayed without delaying the entire project. So let's start with node 1. We're going to do ESTs first. So we're going to start with 0. So we'll start with the A path. So 0 plus 3 is 3, and then we'll go AC. 3 plus 4 is 7. For AD, we've got 3 plus 5 is 8. And then we've got two paths to get into node 5. We've got ACF and ADG. So ACF is 13. So that's 7 plus 6. ADG is 11. And we said here, when there's multiple paths, we're going to use the biggest answer because it's the earliest I can start. I can't start after 11 weeks because we're still waiting for F to finish. So that's going to be 13. And then we've got a pathway to get into node 6. So we've got ACFI is 21. We don't know whether that's the longest pathway to get into node 6, sorry, because we haven't done the bottom path. So let's do the bottom path. 0 plus 6 is 6. 6 plus 7 is 13. And then 13 plus 12, BEH is 25. So it's going to be 25, which means in the top right corner there, our critical path of activities, the longest path to the final node is BEH, and it takes 25 weeks. We can annotate our critical path by just drawing those hash lines there. You don't imagine you'd need to do that in an exam, but that's how you do it on the model anyway, to identify which are the critical activities. Those critical activities can't be delayed. We'll come back to that in a minute. Let's do our latest finish times now. So drop the 25, and then we're going to work backwards. 25 minus 8 is 17. And then we've got 17 minus 6 is 11. 17 minus 3 is 14. And now we've got two paths to get into node 2. 11 minus 4 is 7. 14 minus 5 is 9. It's going to be the smallest answer this time. We said we did the biggest on the way out. On the way back, we're using the smallest, so that's going to be 7. And then 7 minus 3 is 4. That's one of our options for node 1. On the bottom path, 25 minus 12 is 13. 13 minus 7 is 6. And then 6 minus 6 is 0. We're going to use the smallest answer, which is going to be 0. You'll notice any activities on the critical path, any nodes on the critical path, will have no difference between the earliest start time and the latest finish time. The earliest start time of the next activity is exactly the same as the latest finish time for the previous activity, because none of them can be delayed. Right, lastly, float time. So let's look at I as an example. I is an activity that has an LFT minus duration minus AST. So the LFT for I is at the end of I, the finish of I. So that's 25. The duration is 8. And the earliest start time is at the start of I. So we take the finish time from the finish, the start time from the start. So that is going to be 13. That gives us a float time of 4 weeks. So that can be delayed by 4 weeks, and it still won't impact on the entire project. If it's delayed for more than 4 weeks, then it will delay the whole project. B, E, and H are critical activities, which means their float time is 0. You can work that out. So if we do H, for example, 25 minus 12 minus 13 is 0. For E, 13 minus 7 minus 6 is 0. And then for B, 6 minus 6 minus 0 is 0. So you can see that works through. Let's go through the others. So I'm just going to put them in purple next to the activities. So F has a float time of 4, 17 minus 6 minus 7. G has a float time of 6. C has a float time of 4 as well. In fact, actually between C and F, because they're on like their own little path there, it's between them that they have a delay of potential of 4. And then D is going to be 6 as well. And then activity A has a float time of 4. 7 minus 3 minus 0 is 4. So you can work those all out. Here's an example practice exam question for this one. And so this one asks you to calculate the earliest start times and latest finish times and identify the critical path. So I'm just going to annotate this on the diagram above. So we're going to start with 0. Remember our rules, AST, left to right, add, biggest answer. So 0, and then we've got A or B, 3 or 2, so we're going to go 3. Here we've got AC, AD or AE. So AC is 11, AD is 7, AE is 6, so that's going to be 11. And then ACF or ACG, we're getting the pattern here, aren't we? It's going to be 14 or 13, so 14. And then 14 plus 4 is 18. So our critical activities are A, C, F, H. And then our latest finish times, drop the 18. And we're doing right to left, subtract and use the lowest amount. The critical path goes through all of these nodes, so it's going to be exactly the same. So 18, 14, 11, 3, and 0, and that gets you 4 marks. Right, we've got ratio analysis now. So 3.5. Profitability we're going to start with. So we've got 4 calculations for profitability. We've got the gross profit margin. Now, if you have watched the Theme 2 video, 3 of these came up in there. I'm using the same examples, same calculations, so apologies if I'm repeating anything, if you've already watched that one. But there is an additional calculation in this one. So we've got gross profit margin, which is our gross profit as a percentage of our revenue. So that's after when your cost of sales have been paid. We've got our operating profit, which is the percentage of revenue earned as operating profit. So after cost of sales and fixed overheads have been paid, so our total costs effectively, like our total running costs anyway. Net profit is the percentage of revenue earned as net profit, so after all costs have been paid, including financing costs. And then ROCE, return on capital employed. Some people say ROCA. A student I tutored used to say ROCA. I've always said ROCE. I don't know which one's right, but I don't think it really makes a difference because it's not a speaking exam. But return on capital employed is operating profit over capital employed. And I've made a little note there to say that capital employed is our non-current liabilities plus our total equity. We're going to see that in a bit more depth when we look at the examples. And this is the percentage of the finance invested that is earned as operating profit. So, for our table here, we've got a gross profit of 365, operating profit of 145, and a net profit of 100. We've got both tables here because we need both tables for ROCE. So we're going to use these tables for these examples. It's definitely worth pausing and giving them a try first. I've put the formulas in the top left corner, and then we'll go through the answers. Press resume when you're ready. So gross profit margin is, we've got the formulas already on the right-hand side, on the left-hand side, sorry. We are going to do a bit more depth on the capital employed side of things. So capital employed is our non-current liabilities plus our total equity. That is 420 current and non-current liabilities. Our total equity is our share capital and our retained profit. It's our internal finance. That's 468. So that totals 888. We're going to use that later on. Gross profit margin works out at being 67.59%. Operating profit margin is 26.85%. Net profit margin is 18.52%. And our ROS is 16.33%. So let's go through what these mean. Gross profit margin is basically how much profit we've kept after we take into consideration our variable costs only, our cost of sales. So a business that spends more on variable costs and like direct costs will have a much lower gross profit margin, whereas a business that spends very little on those has a really high one. I use the example all the time of like a gym or a hairdresser's, like a barber's, for example. There aren't that many variable costs because a lot of the costs might be fixed, for example. In which case, they could, like the gym, for example, there's nothing they really pay for as a direct cost or a cost of sale. When I go to the gym, like they will mostly be spending their money on fixed costs. So that'll affect their operating profit, not their gross profit. So you might find a gym has a gross profit margin of nearly 98%. We've seen an example on paper 3 actually of a gym group case study that had a really high gross profit margin. Operating profit margin is going to be dependent on fixed costs. So a business with high fixed costs will have a lower operating profit margin and probably a bigger gap between their gross profit and operating profit margins. And then net profit margin only takes into consideration our financing costs. So it depends on what they're spending on financing, but you probably won't see a huge drop between operating profit and net profit margin. That's the kind of final profit, I guess. ROS is about how much they've invested. So capital employed is how much capital has been employed by the business, how much money has been used. And that comes from external finance, like loans, non-current liabilities, and the total internal finance, so retained profit and the share capital invested by shareholders. So we want to know if we're investing this kind of money, like £888,000, what percentage of that investment is returning to us as operating profit. So in this situation, it's 16.33%. Again, ROS is going to vary massively for the different businesses, depending on their costs, depending on how they finance their business. So some examples here. For the first one, it's operating profit margin. Again, pause and give these a try. For operating profit margin, we're going to do revenue minus cost of sales plus fixed overheads, or find out your gross profit and then minus fixed overheads. That gets us 179, and we're going to put that into this formula. So operating profit over revenue, 179 over 3359.5 is 5.33%. For Vidsy's return on capital employed, we need to know our operating profit and our capital employed. Our operating profit is our gross profit minus our expenses, so 3.47 minus 2.55 is 0.92. And our current capital employed is non-current liabilities plus shareholder funds, so that's 15.31. So I'm going to get out of the way a second here. 0.92 over 15.31 times by 100 is 6.01% for our return on capital employed. We've also got some financial efficiency ratios. Again, some of these came up in theme 2, but I'm going to go through those two and then add another one. So we're going to start with our liquidity ratios. Current ratio is the amount of current assets we've got for every current liability. This is how many, basically how much we've got in terms of short-term cash, either cash we've got now or cash we're going to have in the next 12 months to pay for our short-term debts, our next 12 months debts. Asset test ratio is current assets minus inventories. We're basically just, it's the same, but we're just taking away some of those maybe unreliable current assets like stock. We don't necessarily rely on stock because it could go perishable, it could become obsolete, it could go out of fashion. So we're looking at our reliable ones. Gearing ratio is our non-current liabilities divided by our capital employed times by 100, and that's the percentage of our total finance that comes from external finance, so comes from debt. So what percentage of our capital employed comes from long-term borrowing? So we've got some examples here again. We're using the same tables, but obviously different formula. So give these a try and then press resume when you're ready to have a look at the answers. So current ratio is current assets divided by current liabilities. Asset test ratio is obviously the same minus inventories. And gearing is non-current liabilities divided by capital employed. We're going to use the same capital employed as the previous example. So our current ratio is 1.91 to 1. So we've got nearly £2 worth of current assets for every current liability. That's pretty solid. Between 1.5 and 2 is where we want to be. Asset test ratio, take away our inventories of 96,000, gives us 0.92. That's a little bit lower than we'd want. We'd want it to be between 1 and 1.5, but you know, that's not far off. They obviously have quite a lot of stock there, £96,000 worth of stock. Our gearing is 420 over 888, so that's a percentage of 47.3%. So basically 47.3% of their debt, of their finance comes from debt. So they're they're basically funding their business with 47.3% of the finance coming from long-term loans. Obviously there's interest to pay on those things, that's some of the financing costs I would imagine. And maybe it's a bit riskier as well, but there are of course benefits to using those areas of finance as well. Maybe it gives you access to money you otherwise wouldn't be able to access. Some examples. We've got Morrison's asset test ratio 2014 and 2015. So we know the formula. So 2015 and 2014. 2015 works out at being 0.21 to 1. 2014's works out at being 0.20 to 1. So obviously the difference is going to be 0.01. So both of them are rubbish because business like Morrison's, they've got a lot of current liabilities, a lot of debts in the next 12 months. And obviously they also have quite a lot of stock. And their stock's not that reliable, is it? Because it's a food shop, so a lot of their products go out of date pretty quickly. So there's a risk that if they don't sell those bits of stock, they've paid for them, they're just going to have to chuck them out. For the second, it's the difference in the gearing ratio between 2019 and 2020. So 2019, we are saying it is 45.67%. That is given to us in the little case study there. So we need to work out 2020. We've got non-current liabilities and total equity. So that is going to be 2748, our non-current liabilities, over our non-current liabilities plus our total equity. Gives us a percentage of 59.13%. And it says the difference. So the difference is 13.46%. And then for this last one, liquidity ratios. This was an essay question. Really important to have a look at these. This one talked about the liquidity position of the business. So we can calculate both of those, right? We can calculate asset test ratio and current ratio for 21 and 22. So we're saying 22 and 21. Current ratio for Jonathan Trumbull is 3.31. Asset test is 1.46. In 2021, it was current ratio of 2.47 and asset test ratio of 0.88. So the asset test ratio has definitely got a lot better. It's now well within the strong kind of position of between 1 and 1.5. The current ratio has gotten better. Well, it's gotten higher. You could argue actually that it's a bit too high in the sense that they've got a lot of assets sitting around, like a lot of things worth cash sitting around, and maybe they could liquidate some of that and use that money to kind of invest in their business. There's £491,000 worth of cash just sitting there. Are they making the best, most effective use of that? However, are they going to be able to pay their bills? Yeah, definitely. They've got quite a lot of current assets there. The final set of calculations is human resource calculations, which is nice because this video has been going on for about 3 hours. So there's quite, as I said, there were quite a lot in here, and obviously Theme 3 has 6 units as well, so there's always going to be a little bit more. So these human resources calculations, we've got 3. We've got labour productivity, which is how much output each worker produces in a time period, so output divided by inputs. We've got labour turnover, how many workers leave in a year as a percentage of the total staff. Number of staff leaving divided by total number of staff, or average number of staff, depending on what information you've got, times by 100. And we've got absenteeism, which is the number of days off, and the total number of days. So how much of a time period is lost to absence as a percentage of total days. So our examples, we've got, if output for a factory is 320,000 and there are 18,000 workers, the labour productivity is going to be 320,000 over 18,000. So 17.78 units per worker. If the staff of 50 employees loses 9 in a year, that is going to be 9 over 50. So that's 18%. That's, I don't know if it depends on the business whether that's high or low. Like in a fast food restaurant, that's really low. In a school, you'd be a bit concerned if 18% of your staff left. It suggests there's a level of like motivation there, but within a fast food restaurant, you know, it's not really like a career plan for a lot of the workers, especially the bottom tier workers. They're just doing it maybe part time. you know, yourselves, for example, might have part-time work. If a business has an average absence rate of 14 days out of 365 work, their absenteeism rate would be 14 over 365 times by 100 is 3.84%. So those are the human resource calculations as well. Let's have a look at an example of this. Change in labour productivity between 2019 and 2020. So 2019 is 48,956 divided by 150 workers. So that is 326.37 bikes produced per worker. In 2020, it is 320.93. So obviously the change is going to be the difference between the two. So minus 5.44 bikes per worker per year. They're making less. They've got 34 more workers, and they're making less per worker. Right, hopefully you found those useful. Probably quite a long one actually, but lots of calculations in there, and really, really important that you know them. I think obviously the paper 2 is much bigger in terms of calculations, so combine this with your paper with your team 2 ones to have a look at, and hopefully you'll be in a pretty good place to handle anything that comes out. Remember to have a look at the resources in the description, and let me know if you've got any questions in the comments, and I will see you next time.